Saylor is calling STRC a high yield replacement for your bank account. And if you spent any time on Bitcoin X recently, someone has probably told you just to retire on STRC. And I get the appeal 11.5% monthly income, stable price backed by Bitcoin. If you're a retiring Bitcoiner and you're trying to figure out how to generate income without selling your Bitcoin stack, that pitch sounds almost too good to be true. But for now, we do not recommend STRC to our retired clients because here's what most people aren't talking about. That 11.5% yield isn't fixed. It isn't guaranteed. And the mechanism that keeps the price stable at $100, it could break down in the exact scenario when you need it most. A Bitcoin bear market. I'll show you exactly how that mechanism works in this video, and I'll discuss why I don't think STRC fits in our retired clients' portfolios just yet. I'm Mitch, the founder of Strong Wealth, a wealth management firm helping Bitcoiners retire early and stay retired without sacrificing their peace. Let's jump into it. So just to make sure we're all on the same page, let's start with what is STRC very quickly. Strategies, variable dividend preferred equity product, symbol STRC. Currently paying 11.5% annual yield, paid monthly. You can go to our website to learn more if you're interested. But here are the risks to STRC. And I'm going to start with the simple ones that everyone kind of accepts when it comes to STRC. It's only traded for 9 months. It has a short track record. It started trading in July of 2025. Here we are in April 2026. And it's only recently sticking around par. So over that 9 months, it was at a deep discount to par value. But now we're seeing some strength. We're seeing some demand at that 11.5% dividend yield number. And so we'll see if it continues to stick. Over the last few weeks, that's not a long time frame to be able to say yes or no if this is truly successful and something that I should put a large amount of my retirement capital into or not. Next it's the STRC volatility is at 13.7%. That's similar to the S&P 500 at 15%. So we're seeing the same volatility profile at least over its entire traded lifetime, similar to the S&P 500. And so it's like, is that something that, again, I want to replace my kind of equity, Bitcoin, growth, risk asset bucket with? Do I want STRC to be in there and be a substantial part that I am relying upon? In my opinion, I don't really want it to be. And this is just one confirming factor, but I'll get into more details later about how we structure a retirement strategy and where I just, for now, don't see STRC fitting, in my opinion. Another risk is it hasn't been through a true Bitcoin bear market. It's only been around 9 months. And to be fair, 2025 wasn't a great year for Bitcoin, and now we are in a Bitcoin bear market, but we're still in the thick of it. We'll see how long it lasts. We'll see when it recovers. Obviously, MicroStrategy has raised a cash treasury, and they have it over collateralized with their Bitcoin treasury, of course. But again, MSTR is largely sentiment driven, and that sentiment is based on Bitcoin sentiment. And so if we get a bear market that is different from the past, who knows what could happen? So I want to wait and see how this plays out before I am allocating serious capital to it for our clients. And you can see down there at the bottom, their correlation numbers to Bitcoin and MSTR. A 60% Bitcoin correlation and a 67% correlation to MSTR, in my opinion, is still a warning signal. Again, I do not want something that is heavily dependent on Bitcoin and it's going to move in tandem with Bitcoin and relying on that for my retirement income. What I see most people talking about is, oh, well, you hold some Bitcoin over here for your long-term growth, then you hold some STRC and that's what you produce for income. Well, if these are both correlated, even though, STRC might not be moving the same percentages that Bitcoin and MSTR are, if they're moving in tandem, that's a bad outcome. Because if Bitcoin's not doing well, then the chances are STRC is not doing well, which, again, we don't want to be heavily dependent on it for all of our retirement income. Next the continuous yield increases signal low demand. Now, to be fair, again, this last chance to raise the STRC dividend yield, they did it. They kept it at 11.5%. And we have been seeing that demand with STRC staying around $100 and trading there, and MSTR being able to ATM it and use that money to buy Bitcoin. That's a positive sign. But again, just one time, that happening one time is not, okay, this is going to happen in perpetuity. This is going to happen forever. Another note, 11.5% yield is not permanent and can drop in the future. So if you're thinking about your retirement income, you're probably thinking of it as, okay, well, how much capital do I need to have in this asset or in this portfolio in order to be able to spit off X percent? And your percentage that you're kind of spitting off, quote unquote, is your expenses. So if you're spending somewhere in the, around $150,000, something like that, you might run the numbers and be like, well, I only need to have X amount in STRC versus some other type portfolio, and that allows me to get more retirement income. Well, sure, but that 11.5% is not a permanent number. What happens when it drops to 6%? Now, ideally, that's what MSTR wants. They want that yield to drop because that signals a strong demand and it lowers their cost of capital. And so, if you're heavily dependent on that 11.5% staying there, that's not a very good retirement plan, in my opinion. So those are the simple risks that I think are easy to see on the surface. But there is a hidden underlying long term risk that I don't see acknowledged very often. Let's get into that. Let's lay some groundwork first before we talk about the bear case. This is how the kind of flywheel works in an ideal scenario for MSTR. STRC trades near $100. Strategy issues new STRC shares via the ATM. They raise capital, buy Bitcoin. Bitcoin goes up, MNAV expands. They issue MSTR common shares to offset the STRC leverage and slash pay the dividend. The amplification ratio stays under control and that cycle repeats. That is ideally what MSTR wants to see in the perfect outcome. But let's get into the bear case. Again, this is the underlying risk that I just don't see a lot of people acknowledging right now. And I think is worth mentioning, especially if you're going to be heavily leaning or relying on this for your retirement income. Before I get into the bear case, though, I just have to preface it with a couple things. Do I think this is the most likely scenario or guaranteed to happen? I don't by any means, but it still is a potential scenario that definitely could happen. And this scenario that I'm going to describe is one where Bitcoin's breaking down and STRC is breaking down along with it, which is what you don't want if you're heavily reliant on Bitcoin for growth, STRC for income. Now they're both breaking down at the same time. What are you going to do from there to salvage your retirement plan? Not good. Second thing I need to preface is, I had this idea in my mind of this underlying risk based on the framework that MSTR is using, but I couldn't quite put all the logical pieces together in this sequence. So a lot of this I actually got from a guy on Bitcoin X. His profile or his tag is at actually climber. You've probably seen his posts. You've probably seen Bitcoiners hating on his posts, which, okay, whatever. But I think that there is he serves a good purpose, at least in the conversation, being on the other side of the potential risks of STRC, MSTR, Bitcoin, etc. We can't just have a bunch of content about hopium price predictions and assuming the best case optimistic scenarios. We have to have the space for the other side of the conversation as well. And I think he is one voice that I see doing that. And I think it's good to have that regardless of if it ever happens or not. And so what I'm about to talk through in the next couple slides is influenced by his ideas as well. So Bitcoin fails to hit new highs for multiple years and enters a longer bear market than historically. Could happen. MSTR MNAV begins compressing as sentiment deteriorates. Strategy can no longer run the MSTR common ATM accretively. Selling common below 1x MNAV is dilutive to Bitcoin per share. They don't want to do it. Without the common ATM running, there is no mechanism to offset the leverage that STRC has already created on the balance sheet. So whether there's still demand for STRC or not, there's already going to be that big liability, that big leverage on the MSTR balance sheet from STRC. The amplification ratio, which was around 30% in a bull market, which is the target for MSTR, but they have to be able to dilute the common in order to keep it there. It begins climbing towards 60% plus as Bitcoin net asset value falls and preferred obligations remain fixed. The average preferred yield across all instruments is approximately 10%. This is just a number as of now. 10% cost on 60% amplification means approximately 6% net asset value bleed per year just to service the dividend obligations from MSTR. These 2 points right here were specifically from actually climb on Twitter. Continuing on, strategy is now bleeding Bitcoin value every year just to keep the lights on. Not good. They don't want to issue more preferreds. Amplification is already dangerously high, so they can't raise capital there. They can't sell the MSTR common below 1x MNAVs. They can't raise capital there. The only other choice they have after they run out of the cash treasury that they have is to sell Bitcoin. And, is that necessarily a bad thing in MSTR's case? It's not. But the thing is the MSTR common shareholders are, heavily leaning or trusting Saylor that, his never sell your Bitcoin mantra is going to be true into the future. So if they change their tune and start to sell Bitcoin, I don't know how that's going to fare among the shareholder base. So strategy begins selling Bitcoin, framing it as selling only higher cost basis coins to preserve the return on capital dividend treatment of STRC. Bitcoiners and MSTR common shareholders react with a fury. Strategy is now actively suppressing Bitcoin price. Could be the narrative. If MSTR, the largest institutional holder of Bitcoin, the largest single holder, of Bitcoin, if they start selling, okay, now we're potentially, in a bad place. And if sentiment's already pretty low, they're going to be driving it even lower. Bitcoin selling forces NAV lower, amplification ratio climbs higher, more Bitcoin must be sold to service the obligations, net asset value drops further, amplification ratio crosses 100%. At this point, the common shareholders are mathematically entitled to 0 Bitcoin per share in liquidation. The MSTR common collapses toward 0.15x MNAV, just a random number. Investors collectively realize the structure cannot survive. Not good. Everyone's going to be jumping ship. Bye-bye strategy. They can pause the dividends, but then why would you own it? If they pause the dividends, then you don't want to own it for retirement income. It completely defeats the purpose of having it in your portfolio to begin with. Your retirement income shrinks / disappears at the time you need it most during a Bitcoin bear market. Not good, because anyone who's relying on STRC for retirement income, they're probably relying on Bitcoin heavily in another portion of their portfolio as well. So if both are breaking down at the same time, not a good scenario. And again, is this necessarily like a die scenario for Bitcoin? No, Bitcoin doesn't have to die in order for strategy to sell Bitcoin and eventually, possibly, fully collapse and liquidate all of their assets. Bitcoin doesn't have to die because of that. Is this my base case or highly likely scenario? No, I already told you that. But the fact that this can happen, this is a possible risk, and I don't want to take that on instead of the other assets I would hold STRC in place of, which takes me to my next point. Here's a simple bucket framework that you can use in retirement. Bucket number 1 is cash in your checking account. You're actually using this for your expenses. Can be 6 months to 1 year worth of expenses. And again, this is just in cash ready to spend. Bucket number 2, though, is a fixed income buffer. That can be in treasuries, treasury inflation protected securities, or other money market, cash-like assets where we're earning some yield on it so we're not getting killed by inflation. That's an additional 6 month to 1 year worth of expenses. Then we have our bucket number 3, which is our risk assets. And for our clients, that's typically cold storage Bitcoin and Fluvius, our proprietary investment strategy. Within our strategy, we're invested in Bitcoin, commodities, and equities. Those sleeves can change. We do have sell signals. We can liquidate out of any asset class when we're told to do so. That's beside the point. That's all the asset classes that we can hold. And in my opinion, that's probably what most Bitcoiners hold within this bucket number 3, regardless of if they're working with us or not. All right. So what would STRC replace in this bucket framework? Well, it wouldn't replace cash. As much as Saylor wants to say that it's a high yield replacement for your bank account, it's just not. Bucket number 3, it's not a replacement for risk assets. This is what I see most people talking about. They either talk about fixed income or they talk about, well, you can just get a similar return to the equity markets like an S&P 500, but without the risk, without the volatility. Well, in my opinion, and based on our performance in our portfolio and Bitcoin's long-term performance, I think we can easily outperform the 11.5% yield, assuming it even stays there. And so you have to look to bucket number 2 now. This is, in my opinion, the most likely one where most people would look at this framework and say, well, you could put it in there for sure. And can we? I mean, you could, but let's talk about that. So do we want STRC to replace our fixed income buffer? I don't think so. And this is just my opinion. Why not? Well, this bucket is not for high yield, growth, or risk taking. We simply want to offset inflation over the short term. So, this is not to earn us a higher yield. This is not to grow our retirement assets. That's what bucket number three is for. This is for giving us a buffer between our risk assets and our spending so that we can choose to not sell risk assets and not be a forced seller of risk assets at a bad time to do so. So, if we have the buffer in place, we can have our cash that we're spending, but then we also can have that second buffer that we can continue to live off of. We could sell those, live off that, and give our risk assets time to recover and get through an extended bear market. So we don't want a negative Bitcoin scenario to also destroy our fixed income buffer because our risk asset bucket is likely already significantly exposed to Bitcoin. Exactly what I was saying earlier, where you already have your risk bucket significantly exposed to Bitcoin. Why also expose your bucket number two to Bitcoin? In my opinion, it's just not worth it. That buffer is in place to be there when SHIT hits the fan. And it's also worth considering, is the yield really worth it? So this is what most people are chasing, is the yield. Is that worth it? Scenario one, we're just using the T bills in our typical structure in that bucket number two. Scenario two, we're using STRC in that bucket number two. The yield differences as of current rates, well, 150,000 in T bills would be about $5,445 per year as of current market rates versus STRC at 11.5% would be 17,250. So that's a decent difference, $11,805 difference. But when you really take a step back and ask yourself, like, is that going to make a large difference in my retirement success? In my opinion, it's just not. I mean, I've run a ton of retirement plans, and I just don't think that 11 that difference in yield, that spread, is going to mean the difference between success and failure. But what can mean the difference between success and failure is a breakdown of STRC in that bucket number two entirely, or a breakdown of bucket number three that's heavily dependent on Bitcoin. And so, in my opinion, I would rather just not have that because who cares about a little bit more in yield when we're taking on additional risk for it? We're taking on the risk in bucket number three. We don't also need to do it with a small portion of our bucket number two assets that are meant to be a buffer against the negative scenarios in bucket number three. Just doesn't make sense. It's kind of like, why would we? Not worth it yet. So, what could change my mind? To be fair, speak to both sides. The biggest thing, in my opinion, is that strategy finds a way to fund dividends without diluting current holders or common equity holders. So they're not funding their business, they're not funding the dividends, they're not funding their Bitcoin buys through dilution. Because if that has to continue, that is the biggest thing, that could break down, is because you can't dilute continuously. Eventually, you're going to run out of people to dump on. Second, their longer track record. If we get through this full bear market, we get through another Bitcoin cycle, and STRC is hanging strong, looks great. That's obviously a step in the positive direction. Third, there is lower T-bill rates versus higher STRC yield. So the spread on what you can make with STRC versus T-bills, this isn't a major deciding factor in my opinion, but it is another factor that if it continues to gain higher yield, then maybe that might make it worth it at some point. But again, on the flip side of that, a higher yield on STRC just means that demand is not strong and there's more risk involved with STRC. And so it's like, do we really want to go after it in that scenario? In my opinion, probably not. The other caveat that I'll add that I did not include on here is just the fact that, MSTR is heavily collateralized. And so, is this going to be a flip the switch type moment to where things fail overnight? Of course not. And so it's going to take time to play out. And if you wanted to have this as a portion of your retirement portfolio, I don't think it's the worst decision in the world if you're paying attention to things. If you're looking for a strategy that you can implement and you can rely on for the long term, obviously I don't want to be heavily dependent on STRC for all the reasons that I mentioned. But if you're someone that's paying attention to this regularly and you want to be paying attention to this and it's not going to cause you a ton of stress to do so, then maybe you could have an allocation to STRC as long as you're not fully dependent on it for your income. Because you could always Maybe you could always sell and move on to other things if you start to see this kind of scenario that I described play out, or some other scenario that we haven't come up with yet play out to where it could lead to the failure of STRC and the failure of your retirement income. So that is why we do not yet recommend STRC to our retired clients. Again, a Mitch from Strong Wealth, we're a wealth management firm helping Bitcoiners retire early and stay retired without sacrificing their peace. If you're interested in more Bitcoin retirement related content, you should go watch this video next. It is the biggest Bitcoin retirement mistake that I see, how to fix it, and the trap that causes it. And so you can go check that out on our channel and watch that because you might be running into this trap if you're thinking about retiring soon. This can be a very big help for you. Thanks for watching. I'll see you in the next video.